Welcome to the weekly update, where I'll go over the action in the market for the week of August 5th through the 9th, and then we'll see how things look for the week of August 12th through the 16th. Had a slight down week. You'd never know that after what happened last Monday, and everybody was talking about it, and we'll go through and look at the charts. But by the time we finished out the week, the S&P was virtually unchanged, just down slightly, where some indexes actually saw some gains on the week. So just before I get started here, please know that the daily videos that I do, that's the real foundation of the analysis. And I know that the weekly videos, for some of you, that's pretty much all you can watch. But after days like last Monday or periodically, the daily videos are available publicly right when the market closes. The members in the program that I have, they have early access to the daily videos, and I set up a timer right when the day closes. So if it's Monday's video, right when Monday closes, boom, it clicks over and becomes a public video that anybody can view. The idea behind the daily videos is we're analyzing things before the market even opens, where when you have later access, it's looking at information that may be slightly outdated at that point. There is a PDF available below in the description of every video that I upload. There are also a thing called pivot points, which can be very helpful. There's a daily chart and an intraday chart that I update every day on the YouTube community tab. There is a private Facebook group. Some of you may want to have some interaction with me, but not necessarily become a member of the program, and you also belong to Facebook. Please feel free to send me an invitation. There's not an awful lot of back and forth in that group, but if you want to join and ask a question, I really only post whenever I upload a video. If you have something else that you would like me to put in that group, please let me know, and I'd be more than happy to do that. Also, and I've been having a real problem with Rumble comments, and I even post kind of nasty little notes on there too, and they still come in there with their, I'm a social media expert, I can take your channel and turn it into this great, wonderful thing. I'm not interested in those comments, and I go through and I delete them. If you have a legitimate comment, either on YouTube or Rumble, I am completely open to that. Whether you agree, disagree, maybe you don't see something the way that I was trying to explain it in the video, that's fine. I have no problem with that. It's these garbage spam type of posts. Those are the ones that I do away with. I do post not only on YouTube, but also on Rumble. Here's a link to that channel. I do have a program. It's called the SPXInvesting Program. Had a really good day on Monday because we were already set up. We saw things turning negative before they actually happened. Now, later in the week, not so good. It looked like we were going to be going down, and then Thursday ended up being an up day. So those positions didn't work out quite as well, but the ones set up last week and carried over into Monday, they did great. And on the website is where I actually share a video. I do an extra video, and I talk about some ideas that you want to consider. I focus on the short term, intermediate term, and the long term in those videos and in the overall program. If you want to learn more about this, there's a link that'll take you to the website. There's also a link that'll take you to more videos that you can watch to learn about the program. There's an email address here if you want to contact me, if you have any questions or any kind of feedback that way. As I stated earlier, the daily video is the real foundation of what I do. All of the other videos around the outside, they are meant to augment or supplement the daily video. There's also another thing called supplemental videos. I just create those on an as-needed basis, and I really just post those on the website. It's a topic that may have to do with the stock market. It might be interesting, but not necessarily directly involved in our analysis that we're doing every day and every week. Another YouTube channel that you may find interesting is Shivaco Capital. That's a weekly video by a money manager, whereas I like to say I'm an educator, but I also have 30 plus years of experience in the markets. But he takes a bigger picture look. He also looks at different markets, but he also really analyzes the S&P itself like I do. And you might find his perspective to be useful to you. Another YouTube channel is Bob Kendall, another gentleman that's been around for a long time. And he analyzes the S&P, the NASDAQ 100. He'll look at Bitcoin a little bit, and he looks at interest rates. He starts with weekly charts, goes down even to daily charts and even some intraday charts. So you might find his videos helpful and useful and interesting. Okay, let's go back and talk about this past session. So we were down 0.04%. You'd never know that. We fell, what was it, 3% on Monday? And by the time we scratched our way back, we were virtually unchanged on the week. We were above average with volume when you look at it all together, but this is a warning sign. The big up day on Thursday and then on Friday, those were below average volume days. And that's technical analysis 101. When we see a move in either direction on lower volume, we have to follow price because that's the ultimate indicator. But we're a little bit aware of this. When we see an upward move and volume really drops off, that's just something to be concerned about or just keep in the back of your mind. We're still looking positive, but we're seeing some negative signs in the bigger picture here. And this upcoming week, we're going to get a read on PPI, CPI, and retail sales. And so this will possibly adjust the inflation and interest rate scenario. Now, and I couldn't believe it on Monday. When things like this happen, you'd think it was a market crash. Of course, all the perma bears were they probably didn't even sleep that night. They were so excited. But they were calling for emergency rate cuts. And was people that didn't even understand or they can't even spell the word VIX suddenly were making posts online about this is the VIX and this is how crazy it's acting. But they have no idea what it even is. And that's usually what happens. See, this was building up. This just didn't happen on Monday. This was starting to build up in the middle of the previous week. And we were starting to see some deterioration. And that's when we set up some bearish type positions. I have my long-term portfolio completely hedged. So even if it just tanked 10 or 15%, that means that the hedge would replace what is ever lost in the long-term portfolio. So I wasn't stressed out about that. But then at the same time, since we were going down, it gave an opportunity to take advantage of a downward move. And all of that worked out well, at least in the early part of the week. But then when you hear about it, when people are talking about it, they're making posts online about it, it's over at that point. You need to see these things build up, and because they give clues before they're going to happen. And so we especially on the daily charts, we were seeing some real signals there. We also want to keep an eye. There's a lot of crazy stuff going on in the world right now. There's the war between Russia and Ukraine, which seems to kind of get pushed to the back, but it's still going on. There could potentially be an escalation in the Middle East. As I record this, there's still at least another day in the Paris Olympics. Of course, that can sometimes turn crazy. There's been unrest in the UK, and then there's all the political stuff going back and forth in the US. Now, that doesn't seem to really have an impact on the market, but sometimes things can escalate and they do have an impact on the market as well. Okay, now we are seeing a change in our trend. We're looking more negative here. The red line has dropped below the green line, and I'll show you that chart when we get there. So we're actually defaulting to negative on the weekly chart of our trend condition using the ADX. All right, just some bullet points. Most of the major indices, and that's the right way to say it, where usually I say indexes. Apparently, the American way is indexes. The British way is indices. This was a very volatile week, and by the time we got done on Friday, we were little changed. And this was a continuation of a global sell-off that continued the week before. This really started to pick up steam when the employment situation report came out weaker than expected. But the real catalyst to this whole thing was in Japan. And they have what's called a carry trade. And just to explain that very simply, just for example, let's say you have $100 and you take it to the bank and you put it in a savings account. Well, they might give you, I don't know, 0.1% of interest or something. Well, then, and again, this is an oversimplified example. They may take that $100 that you put into your savings account and then they'll loan it out to somebody else for maybe 10%. So that's a carry trade. And so, yes, they're paying you interest, but they're also receiving interest from who they loaned it out to. Well, that started to get really imbalanced in Japan because they had been at zero interest rates for so long, and the yen was starting to really go up against the dollar. And these folks were very highly leveraged over there in Japan. And when interest rates started to go up and the yen started to go up, all of a sudden people are getting margin calls and they're having to liquidate. And what had been working for a long period of time suddenly was now falling apart. And they had no choice but to just start dumping things. And that ended up sending the Nikkei down 12%. Well, on Tuesday, it regained 10%. And then on Wednesday, I think it was another 3%. So they've got back what they had lost in Monday's session. And this was called the unwinding of the carry trade. All right. Then the S&P, this is another thing that I was watching. And this is when I started to suggest in Monday's session, and I was talking about this in the daily video, we were looking at pretty good support because we set the high back in, I think it was July 16th, the all-time intraday high for the S&P. When we were going down on Monday, we got close to that 10% level of a decline. And that's usually what's considered to be a correction. Well, when the smart money isn't ready for a correction to actually start happening, at least at that time, that's when they start coming in and buying. And we didn't quite get down to 10%. It was like 9.75%. We were also hitting some intraday support, and also we hit some other support in the FANG index as well. When all of those things started coming together, that's when some buying came in, and that pretty much halted the decline that we saw on Monday. But this is something to keep in mind. Keep an eye on the all-time high. And now most of the time it's measured from the closing high. I also measure it from the intraday high. You can get slightly different figures when you look at it that way. And this, quite often, when the market still is positive in the bigger picture, this is when the smart money will start coming in to buy. And that's pretty much what happened. And then the carry trade unwinding, this is having to do with Japan. And then the Nikkei was up over 10% on Tuesday, and then the yen started coming down, so things started to settle down in that. And then the market is also concerned about the slowing potential economic growth in the US. And the idea was, okay, what is the Fed going to cut rates in September? There's a 100% chance that they're going to. It's not that they're going to do it or not, it's how much. And when things started to look a little weaker than expected, everybody was freaking out about that, saying, oh, the Fed kept rates higher for longer, too long. And now it's starting to really damage the economy, because we have to look at the context. If the Fed comes in and cuts rates because they want to help stimulate the economy, that could be a very positive thing, and stocks can really go up after that. If they come in and they start cutting rates because something catastrophic has happened in the economy and we're potentially going into a recession, that's when stocks go down, even after there's been interest rates. So you can't apply this hard and fast rule that rate cuts mean stocks go up or down. You have to look at the context of why are they cutting rates. And for a long time, the market was liking the idea of rate cuts because it was to stimulate the economy and help growth actually pick up a little bit since inflation seems to be under control. Well, last week when the employment situation report came out weaker than expected, that started freaking everybody out, thinking, no, bad news is now bad news. And if the Fed is cutting rates, they should have already done it by now, because we're going to go into a recession if they don't. And so that's what a lot was going on. Now, later on in the week, we saw weekly jobless claims come in. They were actually stronger, higher than expected. Or was it weaker than expected? Yeah, they were weaker than expected. So it doesn't necessarily suggest that the economy is falling off a cliff. But for a few days there, boy, that's what everybody was sure talking about. So this thinking kept the market in check, yet the recession fears, they started to moderate by the end of the week. And that's why we're seeing a little bit of a bounce now, albeit on below average volume. All right, interest rates were up. We're under 4%, but we still closed at 3.94% on Friday, where a week ago we were at 3.79%. And the US dollar index also ended up falling. And then earnings season, it's not as influential now. There's still a lot of companies that will report, but the bulk of the S&P 500 companies have now reported, and they were this past week mostly taken as positive. All right, so looking at the week, the Dow was down 0.6%, the NASDAQ down 0.2%. I mean, that's virtually unchanged. The S&P was virtually unchanged, and we did see some more weakness in the small caps with the Russell 2000. This is a chart that I've been showing for over a year just to keep a bigger picture look at potentially what could happen with inflation. We're still in this downward sloping blue area now, where inflation is coming down. That's good, and the market likes that, and that could really bode well if inflation stays down around this level. What's going to happen is if something happens economically, if some geopolitical event that does influence the market ends up coming in, this could produce what we call hyperinflation or stagflation, where we see a lot of interest rates just really going up, but really no economic growth at that time. And that's what we saw in the mid to late 70s before it finally got under control. We don't know if this is what's going to happen this time. You can talk to people, everybody will give you an opinion, but let's base this on fact, on what's actually happening. And right now, we're still in the downward sloping part of this blue line right now until proven otherwise. Okay, then Renmac did this research. When we're under 4.02%, that helps corporate profits. Now we're down at 3.9, is that 3.94, 3.97? We're under 4% here. So that could be helping profits going forward into the future. Then the number of unemployed longer than 6 months, this is starting to go up. Now, this is only updated once a month, but there's some kind of update that was given here this past week. But this tends to be only updated when the employment report comes out. So once we see this, we're not going to see it again for another month. Then Isabel Net, we're still looking okay when we look at earnings going out into the future. And that suggests, or at least gives the rationalization that it's okay for stock prices to go up because ultimately they trade on their earnings. This is a historic chart. I'm not going to go through all of this. It goes all the way back to 1900 and different events that have happened along the way and then how the stock market reacted to that. Most years have a few bad days. It happens, just like Forrest Gump said, it happens, and then created that whole bumper sticker thing. But this is the average, 5.9 bad days. Well, we had one on Monday, but so far it looks like we're looking at things recovering. And a bad day is defined on this chart as being 2% in one day. We fell 3% on Monday. This is another thing. The Bank of Japan caused ugly deleveraging event. This was the unwinding of everything that I was explaining earlier, and this sent a tidal wave through all the financial markets. And looking at small businesses, they're pulling the jobs market lower. Since most companies are small businesses and most people work at small businesses, this could have an impact on things. We're seeing where this is the loan availability of small business and then comparing it to jobless claims. Just something to be aware of here. We want to see both of these going up for things to be a little bit more positive. And then periods of extreme market concentration during the past century. Again, this is a historical chart. This just means that we've really been going up like gangbusters here. And most of it's the top 10 stocks, the Magnificent Seven, the Great Eight, the Illustrious 11, whatever you want to call it there. And then the prime of strife, clever play on words there. This is just talking about and I have to move this bar here. This is the U.S. prime rate in real terms. That means they take inflation into account. And it's been going up. And it's the highest in 20 years here. And because small businesses have to borrow, they're a lot more influenced by the rise or fall of interest rates. And as interest rates have been going down and small caps, we're starting to see some love. Well, that's kind of in limbo right now. And I'll show you that when we get to the small caps chart. Okay, and then here, this is always interesting, especially on Monday and Tuesday. People are all of a sudden the word recession started floating around on social media and people were talking about it. Well, it's not surprising that a lot of people don't even know what it means. So they went to Google and started to look that up. That's similar to what happened when Britain decided to leave the EU. Right after that, after they voted to leave it, then people went to Google and said, what is the EU? Something they just voted to leave. They didn't even know what it was. So That's why we like to, that's why I really focus on the daily videos. We see things unfolding there that if you waited until Monday to react like everybody else did, it was too late. We saw just this massive increase in puts, which is what they increase in value when something goes down. Well, then we went up on Tuesday. So all those people were losing money. They not only lost because they weren't hedged on Monday, then they ended up losing on Tuesday because they're reacting to what already happened instead of seeing these things as they're developing and being able to take advantage of those things. All right, then FactSet, they're slowing down a bit here since we're getting near the end of earnings season. It never really ends. It's just, it starts off with a few usual companies, then it gets really busy, then it kind of slows down, then it starts off again. So, all right, and then NVIDIA will be reporting later in August here. But they ask a question, and the best that I could see here is the answer to this is no. Are analysts cutting earnings per share estimates more than average for the third quarter? Well, this is what it looks like they're cutting them for here. But if you compare it, the blue dotted lines here to the black line, no, it doesn't look like they're necessarily cutting them. This is the earnings update. As of Friday, 91% of the S&P 500 companies have reported. 78 have been above estimates. And so when you take it together, all of the companies are 3.5% above their estimates. So that's, but they tend to lowball these. They want to blow up their estimates. They want to beat them. And so this is a little game that's played. Yeah, it really happens. All right, here's our intraday chart. Where here we have Friday. See, we were already going down. We were seeing all this stuff actually happening right here. And then boom, we just gapped massively lower. But you notice how we set down here at this S3. These are the pivot points that I update on the YouTube community channel. And we bounced up off of that. And then we came right back down to this level. This told me that we were setting up some pretty good support at this point. And then we were able to go up on Tuesday. We did see it trail off. Then we had a pretty good open. This is where it looked like, okay, maybe things are reversing after all, because it looked like we had a higher open and then we just spent the day going down. Where we got a lot of this back was we had a gap higher on Thursday and closed near the highs. And we had a bit of an update, up about 0.5% on Friday. And so if you take this Friday to this Friday, we were down just slightly with the S&P with a whole roller coaster ride in between. All right, so for the 5 trading days, just the 5 days, not Friday to Friday, but Monday through Friday, all of the indexes ended up being positive. Going back to the beginning of the year, all of the indexes are also positive year to date. Looking at the sectors, we had a slight down week with the S&P, so I sort this according to what was down the most. Materials and discretionary, which has been a real disappointing area, they were down over 1%, where we saw industrials and energy up over 1%. Then on this next chart, we go way over to the right-hand side. We use a thing called a scooter score, which is a way of ranking the individual sectors. And we have utilities, real estate, they like lower interest rates too, and staples. This is a defensive area that we're keeping an eye on. These are all in the 90s. That means these are the strongest areas of the market currently. All right, then we go back and look at the different sectors where we had tech, financials, communication, and energy were up. The industrials were just barely. And again, this is just the 5 trading days that we just finished here. And then we see the other sectors being down. This goes back to the beginning of the year, and where we still have communication and utilities that are positive. And this is a little different way, so it may look different than other studies that you might see, where all of the other sectors are negative year to date. This is our relative rotation graph here, where we're seeing some strength. Now, this goes back a year, and we're seeing some strength in real estate, in the staples, also in healthcare. These are defensive areas, not so much real estate, but these are defensive. And this is what we're keeping an eye on, because these are the areas you take staples, healthcare, and something else, utilities, and they tend to be what really do well when the market's getting ready to decline. So that's been the game that we're trying to figure out right now. Is the market getting more defensive before it's getting ready to fall? You can make a case for either side. Utilities are going up because electricity is going up, and they're going to need it for AI. They're going to need it for all this Bitcoin mining. Healthcare, well, You need that no matter what's going on economically. And then staples, well, these are things that you need all the time: soap, shampoo, toilet paper. And sometimes these companies do better. So, yeah, there's a case to be made that these things are looking better, but there's also a case to be made that maybe the market is becoming more defensive. All right, then this is looking at how tech is still doing the best over the last year. Real estate's really coming on strong with discretionary. These are the things that make life fun. What's really been dragging this down a lot is Tesla. And then healthcare, as I talked about. Utilities are more neutral, where we have the other sectors which are negative when we analyze this over the last year. We look at the main indexes where utilities are shown, and you have to look at this like this is plus plus up in the right-hand corner, minus minus in the lower left-hand corner. We're coming down. We're seeing some weakness here in utilities, the NASDAQ 100, the S&P 100, the S&P 500. So not an awful lot is really showing strength right now. The mid caps, which were stronger earlier in the year, they're still not looking good. But we're seeing some improvement with the transports, the small caps, and the Dow Jones Composite average as well. And then this is looking at what we just saw more represented in chart form here, or graphic, whatever, a list here. All right, then looking at sentiment, this is something that I found interesting. And yeah, there's a lot of buzz happening right now and a lot of love going on with the media. And Kamala Harris is now taking a pretty decent lead against Donald Trump. It's kind of interesting. They still have Joe Biden on the list. Yeah, you could really rake in some dough there. You bet on that, and it ends up happening. And Robert Kennedy Jr., yeah, he's up to 2 cents. So this updates many times during the day. The reason why I follow this is people are actually putting money down on this instead of just answering some kind of a survey. And we did see a real tapering off here, the investors' intelligence. We fell down under 3. We're at 2.51. That's more neutral after they had become, they were above 4. And that's when we get kind of nervous about this. We use this as a contrarian indicator. This is looking at the fear and greed index. We're down in the extreme fear camp here. And this is when we start to use this as a contrarian indicator, because we were below 50. So we were already turning negative. Then we dropped down below 25. We are improving a little bit, but typically when everybody is fearful about the market and want nothing to do with it, that's when we look to start going into buy. And it goes completely against your emotions to do that. The active asset managers, after being really extreme positive, have been tailoring that back. And here's another chart showing the reading coming in at 75.33. The Ulcer Index, we're really skyrocketing up on the daily chart. It is going up, but still below the moving average here on the weekly chart. And this is what everyone, the VIX, what? How do you spell that? It just shot up. It got way up above 30. And did it get up over 65 at some point? And it's still giving us very high readings, but it's well off of the really high readings that we had been getting before. And just a couple of weeks ago, we're down around 12, 13 or so. And so this is potentially putting some real pressure on the market. But seasonally, that's typically what happens this time of year is the VIX goes up. We look at a ratio between the VIX and the 3-month average of the VIX. This is going up because the VIX has been going up. And we look at a long-term moving average, 253 days, because that's usually the actual number of trading days each year. When this is going down, that means the VIX is going down. It's more positive for stocks. This has been going back up lately and causing a bit of concern longer term, but we're not necessarily seeing it in the charts yet. All right, here's another sentiment indicator here. Really dropping down, but not necessarily getting extreme negative. And we look at cash versus the tech sector. This is still going up slightly here, but overall the tech sector has been outperforming, which means the black line has been going down, and that's when we're more positive. This is another area we've been watching. It's the spread between risky and not as risky bonds. This had been very low, showing there was virtually no fear. Well, after Monday, this really spiked up. Now, it's more pronounced on this chart, but be aware this is inverted from what we just saw, where this spread was really going up, which means this chart was going down. Well, it's starting to come back down, but it's still giving us higher readings than what we've seen in 2024. So we just want to watch this to see if this turns and starts to go down again, which means fear is increasing. then we'll want to make note of that. And you can see all the craziness that the VIX went through, especially on Monday. And then looking at the RIDEX bear bull ratio, when this spikes up, and again, this is Thursday, and again, these folks typically react to what's already happened, thinking that it's still going to continue. So they get whipsawed a lot, where they reacted to what happened on Monday, and so they went bearish. And then we went up on Tuesday, so then they went bullish. And then we kind of chopped around. It's not a really prudent way to do things, in my opinion. That's why the daily videos should be watched. And we did see a falling off here, the American Association of Individual Investors. We're still above zero, but we have really dropped down in the latest reading. And that was a week ago. It's really going to be interesting to see what the next reading is. And this is that same thing, just shown in a little bit different way to give you a different graphic here. Then we're looking okay here with the GDP. We're above zero. We're actually up close to 3%, where the consensus is anywhere from about 2.5% to the upside to 1.5% to the downside. The takeaway that I get from this is we're positive with GDP. One of the definitions of a recession is we are negative GDP for 2 consecutive quarters. And even when you look at this, we're still looking positive going forward. And when you look at this, we're still positive even going forward. So these charts are not necessarily reflecting a lot of fear of a recession. This is also not showing some signs of a recession. When this is going down, that means we're doing okay. When we go above the black line, that's when we get concerned. Now, this is what a lot of folks are talking about. And the perma bears love this chart, and they say it has a perfect track record. And maybe it does, except I follow this nice lady, Psalm, I forget her first name, on Twitter. And she said, it might not be right this time. Just like the fellow that won was it a Nobel Prize for discovering the inverted yield curve and impact that it has. He said, well, maybe that's not right this time too. But this is a concern to us. You can't see a number over here, but it went above 0.53. And the perma bears just came out of hibernation, even in the middle of summer, just declaring this is the end of the world as we know it. And it might be, but this is just one signal. That's why I look at so many different things. You cannot base this on just looking at a few little signals and coming up with a whole scenario based on one thing. I know I get accused of analysis paralysis. Go ahead. But I take a bigger picture look, and I use what I call the consensus approach, where I take everything together, and it's served me well for over 3 decades doing it this way. But this was causing some concern, and we'll see if it still produces some concern. But we're not going to know until the next employment report comes out. And then here, we're still looking okay here with the smooth U.S. recession probabilities. We're below the black line. We freak out if we go above the red line. Bray Butters, this is quarterly, and it's coming down. So we don't get this one for quite a while into the future. We will get CPI and PPI coming out this week, so these are probably going to adjust, but inflation's not necessarily spiking up at this time. And then here's the Fed. You see, when you add 51 to 49, that equals 100. There's a 100% chance, according to the market. Now, the Fed is supposed to follow what the market says. But over the last, well, especially since the COVID lockdowns, but pretty much since the great financial crisis, 2008 or so, the markets had more of a tendency to follow the Fed because the Fed's doing things they said they would never do, like quantitative easing and things like that. So now it's like the market has to pay more attention to the Fed and follow what the Fed does instead of the Fed following the market. But there's a 100% chance, according to the market, that there's going to be a rate cut. Is it going to be 0.25%? That's 51%. 0.5%? That's 49% right now. And we see how this has changed. And they're just kind of locking these things in. It's pretty even right now. Then we look at the next meeting on November 7th, where they think that rates at that time, there's a 49.5% chance that we're going to be at 4.5 to 4 3/4, which would be half a percent below where we're at right now. And there's some folks that will be down less over here, and some that think we'll be down even more. But these change every day. You can see how there's a whole wide range of what people think. All right, then looking at the Fed balance sheet, where it continues to go down, but we're actually seeing money added to the balance sheet as of late. And then we look at the year over year, where this looks like it's actually going up, but we're still seeing a decrease here. But we've been seeing that for a while now. These are the overnight reverse repurchase agreements. Here, we just want to see, is this going to spike up or really spike down? That's really what we're watching for here. And we're not seeing anything all that drastic right now. Okay, looking at the advanced decline line weekly chart. We're holding up okay based on price, but notice how we're coming down with a little bit more velocity based on volume. That is a bit of a concern. On the daily charts, that's what I was pointing out. We saw volume going down quicker than price. Sometimes that leads price. Now, that can also be positive. Earlier on, a month or so ago, we were seeing volume leading price to the upside. Now we're seeing it leading to the downside. But we ultimately have to wait to see what happens with price. All right, looking at the new highs, new lows, not really much of a change here, but not falling apart. Even with the down day on Monday, we didn't really see any expansion in new lows. But as we've been bouncing back up, because we've been at these prices not very long ago, we're not seeing a real expansion of the new highs. So we're seeing the 4-week and the 10-week average going down. We're still positive here with the advanced decline ratio. We're above 0. And here is the accumulation distribution. We're still looking positive here. We came down almost to the moving average and we're starting to go back up. Now we're negative on the daily charts. In fact, we're extreme negative. So we'll be watching that to see if things are showing some signs of improvement. And this is the boom indicator. This tries to measure how far away are we from the moving average. It's not a perfect measurement, but it gives us a pretty good idea. Then looking at our trend, this is what's now switching to negative. We have a weakening trend since we're below the moving average. The red line has now crossed above the green line. That means we default to negative even on the weekly chart until proven otherwise. And the Arun is still positive after giving us an extreme reading. It's starting to come down, but it's still quite positive here. We've seen there are 3 signals here with the mass index. 2 of the 3 have been triggered on the daily chart. None of them have been triggered here. We're waiting to see if that third trigger will happen. This tries to tell us when there could be a reversal of whatever was happening to cause this signal. If we were going down, this indicator suggests that we might start going up. But its track record is good sometimes and not so good other times. Then here's a daily chart where we came down. We're still below the 50-day moving average. We were testing at the 100-day moving average this past week. If we see more weakness, are we going to come all the way down to the 200-day moving average? And notice over here where we have 2 days right here below average volume. And those were big up days. All right, so in the short term, according to the Keller market model, we are negative with all the indexes. We're also negative with the NASDAQ 100 in the intermediate term. Looking across the different markets, we're negative with stocks. We're positive with bonds across all time frames, negative with commodities across all time frames, negative with the dollar in the short and intermediate term. And they finally made a change here, but I think they messed something up. And they backdated it too, where the decision point scorecard, we're negative in the short and intermediate term. We should be negative here in the short term, but it's still pointing up for right now. And why do I have this? Okay, I'm doing a new way of putting all the slides together, and I think I might have messed up here. Yes, this is the chart that we should have been seeing here, where you see the drop off in volume. All right, looking at our trend channel, we're falling back, but we're still above the midpoint, and that's long term. This is positive. Even though we came down below R2, we still are above this R1 level at 5110, 5111. If you've been watching these videos for a long time, you got tired of me talking about this in every stinking video as we were dealing with this R1 level. Well, then we finally broke out and got above R2. Now we're starting to come back down to R1, but so far this support level is holding. Then looking at the longer term trend here, the 50-week moving average is still going up, even though price is pulling back. When we use the moving average crossover, the 13 is still above the 50, but we have fallen below the 13-week moving average here. We're starting to look a little more positive. We're crossing back above 0 with the McClellan oscillator. We actually ticked down here a little bit, but we're still above 0 with the summation index. We're negative when we look at this based on volume. And this is one of the concerns. We've been holding up lately better with price than we have with volume. And we actually dropped negative here with the bullish percent index on the daily chart and here on the weekly chart. We dropped below this 50 level. And we're negative here with this Swenlin trading oscillator. We dropped below 0 based on price and volume. That is negative. And we look at the PMO. This is our momentum. We're starting to roll over. We're turning down a bit, but still positive with price. We're actually dropping negative based on volume. Another negative divergence that we're seeing. We ticked up a little bit with the PMOs that are rising. We're declining with the buy signals. We're declining with the PMOs that are above 0 on the weekly charts. We're still above the midpoint here with the percent B. Now, we actually closed outside of the lower Bollinger Band after Monday, but that tends to not last very long, and now that's been dealt with. Now, looking at the momentum here, we're looking down here in the short and intermediate term, and we're starting to roll over and look at a little bit more negative even in the long term. Jake and money flow, looking extreme negative on the daily chart, potentially showing some improvement. We are declining here on the weekly chart, and the red line is coming down. So this is a little bit of a concern. We're also below 0, even though we ticked up with the Chaikin oscillator. This is another smart money indicator that I follow. We're still positive, but declining with the money flow. We're negative with the force index since we're below 0. And this is just a 1 week rate of change, and we were down 0.04%. And we're still looking okay when we go back 50 weeks. We're still above that red line and pretty much going sideways right now. We're still positive here with the 14-week RSI. We're above 50. And we're getting extreme negative here with the Stochh RSI. We're still negative with the Special K long-term oscillator. And we're also extreme negative with this. Okay. Yeah, just in case you missed the first chart, here it is again. All right, the Williams percent are dropping below 50. That's turning a little bit negative. We're coming back above 50 here with the ultimate oscillator. And the vortex is still positive with the green line on top, but it's declining and the red line's going up. The copy curve, after being positive, is now rolling over in negative. We're also negative on the daily chart. And we almost came down to this 40-week moving average, which would be a 200-day moving average. Not quite there, but we were able to bounce up off of that. And when we look at the longer-term momentum, we're starting to roll over in the long-term, intermediate term. We're showing some improvement, but still below 0 with the short term. And all of this is based on weekly charts. We're looking more negative with the Heiken Ashi. We're pointed down with the black candles. We're also looking negative here with the Kegi. It's red here, but we're still looking positive with the Renko, and we're looking negative here with the 3-line break. We're dropping below 0 with our 14-week ease of movement. That's also turning more negative, and we saw some new O's drawn in here, enough to signal a high pole warning. It was generated on July 29th. So we're seeing a bit of a breakdown here with the point and figure chart as well. And this will probably change because I put my little mouse thing over here and then I move it just a billionth of an inch and it changes the date. But it looks like we could be starting a new cycle right around the 19th of August. And we are negative with the Elder's Impulse system on the weekly chart. We're negative with the parabolic SAR. We are negative on the daily chart as well. And so August, well, yeah, we're up 40% of the time with a great return of 0.1% over the last, well, since 2020. And so just looking at the indexes here, we're seeing a bit of weakness with the S&P, the mid caps, but closing well off their lows. The small caps had really been starting to break out, but then have been now pulling back. So when we look at the Dow, we're still in a longer term uptrend, but we're pretty much right at the 13-week moving average. And we look at the NASDAQ, and you're going to see a lot of the same things here, below the blue line, but above the red line here in a longer term uptrend. We almost came down to the 200-day, 50-week, which is a 200-day moving average here with the NASDAQ 100. And we've been able to hold on to that support, at least for now. Here's a weekly chart. As I've been pointing out here, this was looking a little bit ugly here when we opened and closed right about at the same point and then declined after that. But before you read a lot into that and what a genius I am, we were seeing this before as well, and it didn't necessarily lead to a decline. It just happened to this time. Also with the mid caps, below the 13-week, above the 50-week. Small caps coming right back a little bit above their 13-week moving average. The NYSE a little bit above its 13-week moving average. This is a daily chart of the Wilshire. where we're in between the 50 period and 200 period moving average. All stocks still down below the 13-week, but in a longer term uptrend. The FANG index on the daily chart, we came right down to the 200-day moving average. It's not quite as apparent here. And we closed pretty much at the high. So that is a bit encouraging here. The big software companies just pretty much treading sideways now. ARC, which just got hammered, ended up repairing some of the losses and was actually up 0.5% for the week. And the banks were still above the midpoint here with the RSI. The momentum is trying to cross below its moving averages. Things have been rather choppy lately. We're still seeing money going into banks currently. And then we look at Dow theory, traditional Dow theory, where we're coming off of recent all-time highs with the Dow. The transports have been going sideways. The utilities are breaking out, but not necessarily going back and setting all-time highs yet. Here's a weekly chart of the commodities where they are really going down, but on the weekly chart, we haven't seen a death cross here. Oil, this is what we're keeping an eye on. Now, there's two scenarios that we can play with oil. One is if it's going up because the oil companies are making more money and investors like those stocks, and so they're bidding the prices up, that's one thing. But if oil's going up because the Middle East is on fire, that's something completely different. And if things really escalate in the Middle East, we're going to be watching to see what happens with oil. Gold, just chopping sideways here, no matter what all the gold geniuses say here. It's really not breaking out all that much. And silver was down over 4% this past week. We have the dollar, which is starting to see a death cross here on the weekly chart. We're still looking positive on the daily chart. These moving averages move a little quicker here. And copper, we've been seeing this coming down as there's potentially some economic weakness going forward. And we have been going up, although we're off of the highs here with bonds based on price. This is a daily chart of the yields. They have really been falling, but lately bouncing back up over the last couple of sessions. This is a weekly chart. You see where Japan, this is the red area, and their interest rates were low. This whole carry thing was all set up as these interest rates were down around zero. They even went negative for a while, just like Germany did, to try to stimulate their economy. It's like, yeah, you can borrow money from me, and then I'll pay you extra interest just for borrowing it. That doesn't make any sense. But we still have the US and UK rates the highest, and German rates here as well. Looking at some relative studies, this is the intermarket analysis chart going back to the beginning of the year. We have gold doing the best, followed by oil, and then stocks, and then the dollar, where a week ago, bonds were looking a lot better. They actually turned positive based on price. Now they're just slightly negative back to the beginning of 2024. We do a ratio between the NASDAQ 100 and the S&P 500. Both have been under pressure lately, but longer term, they're still in uptrends. The S&P 100 has been underperforming the S&P 500, but longer term, the S&P 100 is continuing to outperform. We look at growth versus value. When growth is outperforming, that's usually when the market really goes up. We've been seeing some weakness here lately as well. Gold to S&P, not really showing that gold has had much more of an advantage over stocks. And gold has been breaking out a bit as we've been seeing some weakness in the dollar. We're turning up, but still going down when we compare bonds with stocks longer term. And we look at discretionary versus staples. This is really going down. That means staples are underperforming. And that is a concern to us. And this is one of the areas when this is going down, that means the market could be becoming more defensive. Because if you look here, we were really going up into the end of 2021, and then everything just reversed and started to go down. And this was 2022. We want to see something like that continuing to develop here. And we look at the low volatility stocks and compare them with the S&P. When we were going down, the low volatility stocks were doing well. They ticked down a little bit this past week. We look at energy to tech, where energy is still underperforming, even though it's been bouncing back when compared to tech. And then this is a weekly chart of the small caps, which look like they were really starting to break out. Well, now they're starting to pull back when compared to the tech ratio or the tech sector. Longer term, we're still looking good here with the NYSE Breadth Thrust, still working off of this ZWAG NYSE Breadth Thrust signal that was generated last October. These are good for a year. And these are what the statistics are with the ZWAG NYSE Breadth Thrust. And the Zoharchak is still on a full-on buy signal. This is a weekly chart going back with the S&P to the 1987 crash. Even though we've been declining, we're still above this trend line. This is a further blowout. And if we get closer here, I'll extend the trend line. It's not as easy as you would think to put these trend lines on here. We're actually declining a little bit here with our 50-day new highs, new lows study for the S&P. And when we look at the new highs, new lows for the NYSE, this is also, it's holding up a bit better when we look at this chart. And this is the NASDAQ 100, where we had dropped below the trend line. Well, we're coming right back up to the trend line now. This is the ratio between the NASDAQ 100 and the Dow. It was starting to break out, meaning the NASDAQ 100 was outperforming. Now we've come right back down to these high levels that we've seen before. The Qs, the NASDAQ 100 to small caps, the Qs are starting to outperform, and this ratio is starting to go back up. And we look at the cumulative new highs, new lows on the NASDAQ, and it's pretty much sideways right now. And then the bottom chart is just a daily score. We look at semiconductors to the Dow. It had really been coming down as semiconductors were underperforming. Now they're starting to bounce back up. We want to keep an eye on the 3-month yield, because look at what happened back in 2007. We rolled over with the 3-month yield and went into oblivion here. This is what was looking like it could be starting to happen. We don't really know that right now. We just keep an eye on this chart. Seasonally, where we should just be having a rip-roaring time here in August, and it's kind of gotten off to a pretty rough start, where August tends to perform fairly well. It's September that can really be ugly sometimes. And here, August on a global basis, looking at world seasonality, April tends to be best. Well, April sucked for us, and now we're wondering what's going to happen here with August. But when we look at June, July, and August during an election year, they all three tend to perform quite well. But September is when we start to get a little bit nervous on this chart. And then this is just looking at this is July. I should be looking at August. Okay, then the first half of August tends to not do all that well. It's the second half of August that tends to do a little bit better. And then looking at the election years going back to 1950, we're up 11 out of 18 times, down 7 out of 18 times with a 1.3% return. So thank you. And I apologize for the mix-up in some of the charts. Like I said, I'm trying to do this a new way that's a little bit faster, and I still have to work out some of the bugs with all of this. So have a really good weekend, and I will talk to you in the next video.